Financial markets and type of securities. This is the first time you will expose to the information that how stock market works, what are the instruments available for trading. We will study financial markets and security offerings, measuring security risk and returns, bonds, stocks, and in the last we will discuss stock dividends. Now let's talk about financial market. What is a financial market? It creates a platform between investor and the lenders. These are the intermediaries. So create and transfer of financial assets and obligations. So what they do is they deal with stocks, bonds, mortgages, loans, leases, commercial papers, certificate of deposit, and governmental securities. Money markets trade debts. Okay, there are two types of markets. One is capital market that deals with the long-term instruments like stocks, and there are some short-term instruments less than 1 year. We call that as money markets. These are also called liquid markets. So money markets are which maturity is less than 1 year, and you need dealers. So these are dealer-driven markets because most of the transaction involve buying and selling through the dealers. They usually have low default risk because the time duration is less. Money market securities include government treasury bills, treasury notes, T-bills, agency security, short-term tax-exempt security, CP, commercial paper, CD, certificate of deposits, repurchase agreement, euro dollars, or certificate of deposits, and banker acceptance. These are certain names of the instruments. In terms of capital markets, famous is NASDAQ, New York Stock Exchange, and every country has their own stock exchanges. We sometimes classify as primary markets and secondary markets. Primary markets are market in which corporation and the government unit raise new capital by making IPOs, initial public offerings. For example, you are Nestle, you want to launch your shares. First you will go in primary market. You will engage an investment bank. They will arrange an investor who will buy your shares. Then they will resell it into a secondary market, that is a stock exchange. So that is a secondary market provide for trading of the previously issued. From here it comes to the secondary markets where you can buy and sell. Companies that we are going to float shares are working under the compliance of SEC, Securities Exchange Commission. So they have their responsibility for listing. They should have a certain type of asset. They should have approval to issue authorized shares, memorandum, article. These are some documents that is commonly used. So SEC asks for regular disclosure requirements, and the greater risk of an unfriendly takeovers are possible disadvantage. For example, if I am a bigger company and I can buy the share of your company more than 51%, so I will be the controlling partner and I can change the whole scenario. So issuing share is always risky, so you have to be very cautious about the shareholding percentages. Stock exchange has expanded their role to include trading in derivatives. What is derivatives? Derivative is a word from derived from a future economic activity. We can buy the rate of dollar after 3 months, oil and other commodities, rice, currency markets. There are a lot of markets where we can trade in future that create a derivatives for you. So there are commodities market like where we can talk about oil, livestock, metal, grain and fibers, any kind of commodity, metal, steel. These are separate market. Every day market opens, they have an opening rate, then there are buying and selling, there is a closing rate. We do have stock exchange, that is for the big companies who can meet the criteria of listing in a stock exchange, but there are a lot of investor and companies, they cannot list them as higher as is the requirement for stock exchange, so but they do want to trade, so they go to over the counter markets. These are alternative investment markets. These are little smaller. Over the counter market is a dealer market. It consists of numerous brokers and dealers who are linked by telecommunication equipment that enables them to trade throughout the country. So all trading in stock exchange now electronic. You have your own softwares. You buy, you sell, you pay by credit card, you have linked your bank accounts with that. So its trading has become more easy and more reliable. Over-the-counter market handles bonds markets, federal, state, local bonds, open-end investment companies, and secondary stock distributions, whether or not they are listed on the stock exchange. This is an alternative market, same like stock exchange. Then he says that the governing authority of over-the-counter market is the National Association of Securities Dealers. It computerized trading with NAST automated quotation, that is NASDAQ system, right? New York Stock Exchange systems. Brokers and dealers on over-the-counter security may also maintain inventory of securities to match buyer and seller order efficiently. Suppose you are a dealer and I come to you as an investor, so you should have enough inventory of shares with you, so we can trade easily. You can facilitate my process of buying and selling. So they should have some stock with them. Financial intermediaries. He says the intermediary obtain funds from saver, issue its own securities, and uses the money to purchase an enterprise security. Intermediaries are always in between people who are always linking buyer and sellers together, creating their own profitability out of that. So financial intermediary, best example is a bank, a commercial bank, life insurance company, because they have premium, so they'll get a lot of money. They have to invest for 30 or 40 years, because after that they have to give a lump sum amount, so they should be smart enough. Private pension fund, non-banks, state and government, local pension funds, mutual funds, and finance companies. Efficient market hypothesis. What is that? Stock exchange we classify in three ways. Like NASDAQ, we say it is an efficient market. How anything happen in the city, it will directly affect the stock index. There is a direct connection. This is the highest form of efficiency. Then we have weakest form, means country is burning, there is no project, but the stock market is isolated and it's going top. So there is no logical connection between economic growth and the stock exchange, right? This is weakest, one is the strongest, and one is in between. So these are three type of markets. Fundamental analysis is the evaluation of security future price movement based upon sales, internal development, industry trends, general economy, and expected changes in each factors. Technical analysis is the evaluation of security future price based on the sale price and number of shares traded in a series of the recent transaction. So technically you will see what is the volume of purchase, sale, movement. That is a technical analysis. The other is fundamental analysis, that you are doing through some movements, but where you will involve the technical figures, it will become a technical analysis. Efficient market hypothesis has three forms. One is strong, as I told you, semi-strong, and the weak form. So market efficiently incorporates public information into security price. This is the concept actually. Anything happening in economy, if it reflects the 100% the same in your prices of the stock market index, this is the form of efficient market, right? Otherwise, markets are not efficient. We